Good afternoon, everyone, or good morning or good evening, depending on where you're joining us from. Today's presentation, brought to you by Counselor Buchanan and Mitchell and MBI, is an investment update and top ideas in turbulent markets. And our two presenters today are Debbie May and Alex Seleznev. This has been the third time in recent months that they have been presenting on this and similar topics. They started on April 16th and then did a May 20th presentation. So Debbie May is an executive vice president at CBM, and she's also the chief investment officer at MBI, the financial advisory subsidiary of CBM. And Alex Seleznev is a senior advisor and a portfolio strategist for the firm. So today's presentation will be about an hour long. I'll leave it up to the presenters to determine whether if it goes long to continue, but the presentation will be recorded. So for those of you who wish to review it, we'll have a link in the next day or two to send it to you. As part of the platform that we're using today, we also have a chat box. So if you do have any questions, we would invite you to use the chat box. Please don't unmute yourself because the presenters do have a lot of content to get through. But they will be responding and monitoring the chat box. And for those of you that are listening in on your phone, the presenters will also be reading out the questions from the chat box. So you'll have access to what's being asked and what questions and points come up. So with that, I think I'm going to just turn it over to Debbie. And once again, thank you for joining us today.
Great. Well, thank you, everybody, for joining us. And I do hope everybody is well. With this COVID thing, with the heat thing, with everything. So I do hope everybody's doing okay. Just want to reiterate that we're not trying to give specific investment advice here. We're not able in this format to answer anyone's specific investment questions. We really just primarily want to give you a market update and a few other ideas to be thinking about. As many of you already know, MBI is an investment management firm. We provide comprehensive financial planning. It includes retirement planning, includes educational planning, consulting, and that's what we do under that umbrella, as well as we do financial planning under CBM as well. And you can just, look at our website if you want to learn more information about that. Okay, Alex. So here's a picture for you. I have to tell you, I had to grab this picture because it literally looks just like my grandmother used to look, although she left us at 88. She used to love to dress up like this and party, if you will. And I also thought it was kind of relevant because just to remind us that we really are doing long-term planning, even when we're talking about retirement. You might have a good 30 years to go after retirement. And we really do want to be focused on the long term, and hopefully a lot of people celebrating their 100th birthday. When we do retirement projections, we're generally taking people to 95 and building in contingencies for even living longer than that.
Yeah.
So.
All right. So, and again, thank you everyone for joining us in this, I would actually say beautiful, Thursday evening, at least here, in Maryland. It's definitely humid and it's getting closer to 90 degrees. So yes, this is our third market update. And in terms of the, agenda, we'll talk mostly about the second quarter of this year. Then we'll talk about our thoughts for the rest of the year, perhaps beyond. And then we'll share some of our financial planning and actually tax ideas. So I'll start with the quarter. And what's interesting about it, the second quarter of the year was essentially the opposite of what we experienced in the first quarter, specifically in March of this year. And as I would say, pretty much all of you know at this point, we experienced a major, actually historic market sell-off in the middle of March. Now, the second quarter of the year was actually the best quarter for the past 20 years, a little less than that actually, for all three major indices, domestic indices at least. We're talking about the Dow, S&P 500, and NASDAQ, which is more of a technology-oriented index. So the Dow, which is what we would usually refer to, started the quarter at 21,900 points. We finished at 25,800, and actually, as of yesterday, didn't necessarily move all that much today. We're at 26,800 points. That gives us an increase of 18% for the quarter. And in terms of the year-to-date performance, we're at negative 6%. Now, of course, no one wants to be in the negative, but that's, of course, much better than where we were in March and April. Now, the S&P, which is, more of a broader index, the S&P 500, is very close to the break-even territory. It's negative by actually less than 1% as of today. And NASDAQ, and that's, frankly, a complete surprise to me if you asked me this question, a couple of months ago, is up 16% for the year. So that's a, technology-oriented index. In terms of the market volatility, well, there was much less of it in the second quarter. In fact, there was only one day when, any of the major indices was down more than 4%. Of course, doesn't apply to different sectors or other categories, but, less volatility last quarter. In terms of the economic updates, the GDP, the domestic gross domestic product, was down 4.8% in the first quarter of the year. For the second quarter, we'll get the numbers closer to the end of this month. That's how they usually report it. And expectations are actually similar. We're expecting it to be negative, perhaps somewhere between 3 to 5%. What's interesting, though, at least those economists and financial people that I've been following, most of them are expecting the third and fourth quarters of the year to be in the positive, at least in terms of the growth. Now, their expectations, the range is quite wide, but still in the positive. Unemployment numbers, we can't really skip that. It's really all over the news, regardless if you're a financial person or not. And again, if we focus on the second quarter, we started at roughly 15%, which is quite high to say the least. And we finished at something like 11%. And those are your official numbers. One thing I like to say, well, the actual number of people that are unemployed can be much higher than that. Now, that's one of the things we're actually been focusing on particularly. And as some or many of you know, as part of the CARES Act, we now have this enhanced unemployment benefits in place, and they're set to expire at the end of July. And what basically that is, the federal government would pay you an additional $600 per week, in addition to what your state would be paying you. Now, there is a possibility that they would be extended, and there's a lot of talk on that at this point. One of the studies I looked at is actually by the University of Chicago. They analyzed, different industries and how much, people earn in those industries. And apparently for 68% of those who would qualify for unemployment benefits, they would actually be higher than their normal paycheck. So there's that, perhaps potential issue, depending on how you want to look at it. Mm-hmm. Inflation, which is one of the things we discussed in our previous webinar, essentially was non-existent in the second quarter. We're expecting it to be somewhere between 1 to 1.5% for the year. That is certainly not our expectation in intermediate/long term, but for the time being, there's not much of an expectation from the inflation perspective. Now, back to the markets here, back to the stock markets. There's been a lot of adjustments in terms of how different sectors performed in the second quarter of the year, and I'll talk about that in just a moment. But one thing I wanted to focus on is specifically these so-called bargains. Perhaps some of you remember in our first webinar in April, and we actually discussed it in our quarterly commentary. At least from our perspective, there were a lot of bargains, right after the sell-off in March. Now, where we are at this point, essentially 3 months later, we're not necessarily sure that that's any longer the case. Every so often, there would be a question from one of the clients, or I would just discuss it with someone internally. What do you think, Alex, about this stock, X, Y, or Z? It's still down 30, 40, maybe 50% for the year. Is this a good buy? Well, one of the things I always have to think, well, it's been 3 months. People had plenty of time to readjust their thinking. And if something is still down so much at this point, well, perhaps we should think twice before we consider it as a bargain. In terms of the sector performance, some of the leaders, technology and healthcare, and technology is really what drives a lot of the market rally at this point. In terms of the laggards, you've got your energy and financial. Now, what was actually surprising to me when I was comparing these, the difference between the best performing asset class and the worst performing one is more than 50% for the year. The difference between the best performing and the second worst performing is more than 35%. So when you look at the major indices, again, the Dow, the S&P, even NASDAQ, well, it certainly does not tell you the full story. There's a lot of variation when you look, under the hood. So in terms of the anticipated market recovery, so what you're looking at, this is a short version of the framework that we developed 3 months ago at this point. And I'll tell you, not much actually changed from our thinking, but of course more news became available. One thing, perhaps you would find it curious, I did not know this up until recently. I don't know if many of you know why an upward moving market is called a bull market, and market that goes down is considered to be a bear market. So there is some speculation in terms of where the terms came from, but one of the versions is that in ancient times, people used to organize fights between different animals, and a bull would fight a bear. So when a bear attacks its opponent, it would stand up and basically swipe down with its paw. And when a bull attacks, it goes at its opponent with this upward motion with its horns pointed up. So that's one of the versions of why people refer to it this way. In any case, under the bear case scenario, let's call it the worst case scenario, the vaccine would be delayed all the way to mid-2021 or perhaps even later. And the implication of that is that out of 130 companies around the world that are working on it at this point, essentially none of them would be successful, or there would be very limited success in distributing it to the population. Full lockdowns would resume at some point in the fall. Essentially, we didn't learn all that much from our experience in March and April. So comes, September, October, maybe November, we'll be back to where we were in March. Under this scenario, of course, the GDP would decline potentially by double-digit numbers annualized. And the figure, by the way, I gave you 4.8%. That's annualized for the quarter. So perhaps it would be even worse than that. And of course, there would be a very negative effect on the market as well. Under the bull case scenario, essentially the opposite of that, the assumption is that the vaccine would be widely available by the end of the year. And yes, there are some analysts that believe that's going to be the case. We'll have limited lockdowns, and any hotspots that we experience, they would be managed well so that the impacts in the economy of each state or other nations around the world would be relatively negative or limited, I should say. And in terms of the growth, it would only decline by low single-digit numbers. In this case, well, in this scenario, in terms of the stock market, essentially there will be a continuation of what we're seeing right now. Now, in terms of our thinking, which again hasn't necessarily changed drastically that much, even given the rally that we experienced last quarter, we do believe that there will be a vaccine closer to the end of this year, and at least that's what we hear. Perhaps it will be in limited quantities and available to first responders and perhaps those that are in real need to have it. There'll most likely be more lockdowns, and that's pretty much what we're experiencing now around the nation. But perhaps the impact would be moderate. We're expecting the GDP to decline for the year. We are expecting more market volatility closer to the end of this year. Plus, of course, we're in an election cycle. Debbie will talk about that later. But we're not expecting a repeat of the March scenario at the end of this year. So that is our base case scenario at this point. That's one way of saying it. So one of the questions I actually got from a couple of our clients, which I think is perfectly legitimate, and I've been reading about it a little bit, especially in June, are we in a bubble? Are we in a financial bubble? So I don't necessarily want to claim that I'm able to answer that question, but it certainly generates a good discussion. So in terms of the definition, what is it? It's an economic cycle characterized by the rapid escalation of asset prices followed by a contraction. To say differently, something that goes up rapidly, well, perhaps it would go down just as rapidly. And when you look at the performance of the second quarter, well, there's nothing wrong with thinking that way. Now, the second part of this definition is perhaps a little more challenging. It is created by a surge in asset prices unwarranted by the fundamentals. So in order for us to make a claim that we're in a financial bubble, well, we do need to have at least some understanding of the fundamentals of what we're referring to. So if you're wondering what is it that you see on the bottom right of your screen, what this chart is referring to, well, this is the tulip mania or the tulip bubble. And this is actually the very first recorded speculative bubble that happened in the Dutch Republic in the 17th century, or Holland, how they used to be called. So essentially what happened, it's a fascinating story, by the way, but people would exchange their entire estates, their salaries, their savings for a few tulips. So at the time, they certainly thought that there are some fundamentals that would basically mean that there's value in that. And by the way, for any of you who are interested in that, there's a great book called Extraordinary Popular Delusions by Charles Mackay that talks about the tulip mania and many other issues that we had in the past. In any case, back to the markets. If we make that claim, or if we're discussing this, are we referring to the entire market or certain parts of it? And as I mentioned earlier, well, if you look at certain sectors, and yes, I will say it's technology, well, perhaps there is some overvaluation at that point. If you look at other sectors, specifically the bottom 5 or maybe even the bottom 7, well, perhaps not so much. The stocks in those sectors didn't necessarily go up that much in the second quarter of the year. Is there a history of earnings? If we ever look at any particular company, that was one of the major issues, of course, in the dot-com bubble. And the issue was, it's not that there were no earnings, there was also no revenues. Essentially, you would create a company that would be related to internet at the time. You would issue stock, and all of a sudden it would quadruple overnight. If you look at some of the major, even technology companies at this point, well, they certainly have revenues. They have plenty of earnings, and they also have plenty of cash. They're some of the most cash-rich companies, not just in the US, but actually around the world. In terms of the PE ratios, or price to earnings ratios, that's one of the most common ways to evaluate it. We're currently at 24. And what that means for some of you, perhaps not familiar, the higher the ratio, the more richly valued something is, an asset class, the entire index, or any particular company. The average is somewhere between 16 to 17 over the past, multiple business cycles. Last year, 12 months ago, we were at 19. So yes, if you compare it from that perspective, there's certainly some over-evaluation at this point. Now, perhaps those who are, buying at this point, perhaps they're not focusing so much on the earnings this year. Perhaps the focus is mostly on 2021, potentially even 2022 at this point. And one of the practical comments I tend to make, well, if you don't like the valuation of the entire market, well, no one is forcing you to buy into the market as a whole. You can always look at different sectors. You can also look at different asset classes. You can also look at different individual stocks if you would like. So in short, I mean, we certainly see that there's been quite a run up, but at this point, we do not believe that we're necessarily in the bubble. So with that, we'll go to
Okay, well, to talk a little bit about the presidential election, and not to get into politics by any means, but we are certainly getting a lot of questions now that people are remembering that this is going to be a presidential election year coming up in November. And, what does that really mean to the market and in general, what's happened in the past? And this slide you're looking at, which was put out by CNN, was updated in March 23rd, 2020. At that point in time, Trump had experienced 798 trading days on Wall Street, which is where that magic number comes from, and is trying to compare, going back to Reagan, what was their 798 trading days looking like in their presidency for the S&P 500. And you can see what those numbers are in the positive and the negative, and you can see how they cross over the political parties. So it's not all, Republicans, the market's going to go up, Democrats, the market's going to go down, and this just indicates that for you. What we're seeing here really is that the market's doing what the market feels makes sense, from an economic point of view, from a business cycle point of view, from a valuation point of view, as Alex has been stating, and not necessarily, based on, who is in office. This upcoming election, there's arguments that no matter who wins, the market's going to still stay the same. Whether you're looking at, the Biden or Trump win, that there may not really be much difference. And what happens more in the Senate with the president may have a little bit more bearing. We think there's definitely going to be a reaction, like there is always a reaction to news of the day and the uncertainty, perhaps. But, at this point, we think that this is not going to be a big event for the market as we look ahead into 2021. And we basically think that the market is really already forward thinking way beyond the election at this point. Next slide. So this slide really just gives you, again, looking at different parties as a combination, Carter, Clinton, Obama, looking at, almost a 15% annualized rally that, happened in the mid-90s. And then you go to Reagan, Bush Sr., Jr., and Trump, and then looking at where that is at 4.9%. And you'll notice and can remember that during any of those time periods, there was major things that happened that really had nothing to do, with who was in office. You've got the dot-com situation that happened where the tech bubble, as we called it, burst, and there was a major reaction to that. We had 9/11. We've had the 2008 financial crisis built in there. And then, then we've had major rallies that have continued on for periods of time. The average business cycle, which I think Alex mentioned, is about 7 years. We've been in a longer cycle with Trump so far, but normally it's about a 7-year cycle. So it's generally going to cross over, any president's, tenure in office for the most part. Next slide. So overall strategy, preparing for potential continuation of volatility in the fall, I'm going to say absolutely. It's as you can see, it's all over the place. You have to really kind of stay put and think through it. Volatility, when you really look at the market, is really the rate of the increases and declines that have been occurring and how rapidly they're occurring and how unpredictable it is. So that's the meaning really of volatility as we're looking at it, and it's really something to sit through. We're not going to react necessarily to that volatility, in of itself. The volatility is not going to cause financial loss, which I think is what concerns people when they look at the valuation of something on paper. You're not going to actually incur that loss unless you sell something. That's when it becomes absolute. You have a financial loss when you sell at a loss, right? So we're not looking at that as being the meaning of volatility. It's just something that's going on right now in a pretty short time frame, if you will. So what we are looking at in terms of strategy is what we've been doing for the last 25 years is really looking on an individual basis. What do you need for cash? What are you actually going to pull out of your portfolio that you need to live on? And everything is designed around that. You want that money, in our opinion, to be coming out of fixed income. We establish a buffer that has to do with the cash that you need to pull out. And generally, we're doing that over about a 7-year period, having to do with business cycles. The whole idea being that we don't want to sell at a loss out of the markets, not knowing exactly when the dips are going to occur. We want to have that money positioned in a fixed income scenario that basically allows you to not have to worry about that and keep your equity portfolio intact. So that's what we're looking at. I mean, we're trying to understand, what you're going to pull out of your portfolio. So even if you're approaching retirement, for example, we're going to be looking at budgets. What else do you have coming in terms of Social Security, and what do you need to really support your lifestyle, and do some mathematics on that. So it's very custom. It's not really just driven by a particular age or a particular amount that you have in your portfolio, because spending is different for everyone. There's also two kind of buckets of spending, and one of them is what I call the bare bones stuff that's really not going to change. It's all of your fixed expenses, and kind of identifying those, keeping a roof over your head, your medical needs, eating, those kinds of things that really you can't change very much at your discretion. And we want to make sure that even in a down market, I mean, do you really have that covered? No problem. Because if you did have a scenario where your discretionary expenses needed to be cut for some period of time, not the rest of your life, but maybe we're talking over the next 6 months, 12 months, you can say to yourself, yeah, I'm not necessarily traveling right now, and I don't have these other expenses that I really have to spend while I'm going through a situation like this or a market downturn. And what we mean by stress testing your assumptions is kind of that, as we're looking at, well, what if the market did take a big dip and it stayed that way? And that hasn't really ever happened. The market's continued to go up out of all kinds of debacles we've had. But what if that happened and you had a 20, 30% cut in your portfolio value? What would that look like in terms of your net spending, so that you can look at that and be able to sleep at night, or know that, whether you're really more risk adverse or able to take risk in general. So in terms of strategy, what we're doing is staying fully invested with our clients, with their investment policy. We're still following that, their game plan, their long-term plan. And because the market is moving, and like we've been talking about, this volatility of up and down, we are rebalancing people's portfolios based on their investment policy as things are changing more frequently, I should say, than we normally would, which is at least twice a year, right? So we're doing that more frequently and looking at clients' portfolios so they can really stay positioned the way that they want it to be positioned in the first place. We also are looking at clients that have brought cash into the table. They say, I got this cash, how do I get it invested? And we're basically doing it on a slow basis. We're doing it over time. It could even be over 12 months. It could be over 6 months, but we're trying to take it step by step and not necessarily saying we're going to go all in at one time, go slow. As the saying goes, pigs get fat, but hogs get slaughtered. And we're just trying to be mindful of that. And you can always look backwards and say, I wish I put it all in today, or might feel the reverse. Wish I had waited till the end of the year, but we just don't know. And I could give you so many examples of past cycles that were surprising. So usually tiptoeing also has a good psychological impact to keep people from feeling paralyzed of taking any action. And then we're also really focusing on people's fixed income allocation, that they do have a buffer, that the buffer is, very secure. We're not looking for the nth dollar of interest. We're not looking for that portion of the portfolio to be a major income producer, but we want to make sure that it's, again, in place, that you have the buffer and the peace of mind, that in this market volatility, it's going to be okay from a cash withdrawal or not taking a financial loss by selling situation.
That's right.
Okay. Just going back. Okay.
Yeah. So this is actually one of those interesting slides. I'll tell you, I haven't seen these for a little while. And then, when we were reading multiple things, this came up, and we thought it would be actually a good time to include it in a webinar like this, especially since, again, the market's recovered, by quite a bit at this point, and perhaps people are rethinking their strategies. So what has the greatest impact on investment results, right? One of the key questions. So of course, we know there are many studies saying that your overall asset allocation has a huge impact in the long run. So somewhere between 70 to 90% of your long-term performance results can be explained by your, split between stocks and bonds. Of course, how well, you select your different investment stocks, bonds, ETFs, that has some impact as well. Now, if we look at the performance of some of the, major indices over the past 20 years, and in this case, by the way, does not include 2020. So that's important. The US stocks are up more than 8%. Basically, we're talking 3 business cycles here. Bonds as a group that include, treasuries and corporate bonds are up 4.5%. Not bad either. And inflation, as perhaps many of you know, it's been low for a while now. Now, when in this particular case, it was Invesco and Bloomberg, when they analyzed, and I just want to make sure I explain how this analysis was performed, they analyzed how people exchanged shares of their retail mutual funds between different asset classes, stocks, bonds. They realized that this average retail investor earned less than 4% for the same time period. Now, one important piece here when I was looking at the disclaimer for this analysis, exchange traded funds and stocks were not included. My thinking is that if you include those, it would most likely be even worse. Why? Because ETFs and stocks, they can be traded much quickly. So you just press the button and they're essentially sold. So what does it tell us? If you think of the golden rule of investing, so to speak, the idea of selling high and then buying low. Well, most people do understand it, but very few actually implement the strategy around that. So in this, again, this is just a great example of how much investor behavior, of how big of a role it actually plays in your long-term performance results. So we found it interesting. Now, one of the technical points for our presentation today, and we try to include 1 or 2 in our webinars. Last time, as some of you perhaps remember, we talked about large cap stocks that have a history of paying dividends and have a potential to increase those dividends. And the idea is, of course, given where we are with interest rates, very low, essentially at 0 at this point, many people are seeking income. So where would you get it? So here's preferred stock. And what is it? So to give you a simple explanation, it's a hybrid asset class that is somewhere between stocks and bonds. And why do I say that? Well, it's more secure than a common stock of let's say the same company, but it's certainly less secure than bond of the same company. What I mean by that, if you think of the ultimate risk, meaning the company going bankrupt, well, the bondholders get paid first. Preferred stockholders would get paid second, perhaps some. Now, common stockholders usually don't get paid anything, by the way, if there is a bankruptcy. Now, in terms of the advantages, why would you even consider these? Well, one of the immediate benefits, they tend to pay significantly higher dividends. And in addition to that, they tend to be fixed. So if you look on the right of this slide, this is as of yesterday, the US stocks yield 1.85%, US bonds as a category, as a group, 2.5%. Treasuries, by the way, are somewhere between 10-year treasuries specifically, as at 0.64%, if I'm not mistaken at this point. And preferred stocks as a group, again, pay 5.3, which is significantly higher. Now, just like with any other asset class, you can invest in more conservative preferred stock, perhaps those that have shorter maturities. You can invest in longer maturities preferred stock. Perhaps you would get even more than 5%, and on average, it's somewhere between 5 to 7 years. With preferred stock, by the way, one of the features, it can be perpetual, meaning that it's there indefinitely up until the company actually calls it. Now, another benefit, I already talked about, less risk than common stock. The price tends to be relatively steady, and relatively is a very important word here, relative to stocks. I'll tell you, preferreds as a category were down more than 12% in March of this year. Well, again, doesn't sound all that great, but compared to stocks, that's certainly better.
Common stocks, yeah.
Common stocks, that's right. So in terms of the disadvantages, well, there is limited appreciation potential. And what that means, most preferred stock is issued at a par value of $25. So let's say, you took advantage of it at some point in March or in April, and you were able to buy it at $23 a share. All right. So if it's, redeemed in 5 years, well, essentially what you're going to get, your money back, or you're going to get $25 back. Your gain would be $2 plus, of course, whatever you earned for holding it for 5 years in my example. This is actually one of the key features why many advisors, including actually our firm, we do consider it as a fixed income portion of our portfolios, and I can absolutely see how someone would argue it should be on the equity side, but we do think of it as a fixed income portion. One other piece, by the way, you don't see it here, perhaps it's not all that important for most people, but you don't have any voting rights. And that's perhaps one of the key differences. So as a preferred stock holder, you cannot really vote. Now, one of the disadvantages here, which is also important, and I touched on that in just a moment ago, it tends to be less liquid actually as both common stock and bonds. Under normal circumstances, you're not going to have any issues necessarily, but in times of market volatility, you may have some, because of course there's less of it. So if you ever decide to include it in your portfolio, well, the assumption would be that this would be your buy and hold portion of your portfolio. The idea is that you would not be essentially selling it for your ongoing cash needs, even though perhaps it's part of your bond ladder, is how we refer to it. So in terms of some examples who would potentially benefit from this, well, of course, people who are seeking income at this point. They live off their portfolios and they need income to maintain their lifestyle. Perhaps those who are in a lower tax bracket, because again, they do pay handsomely, but all of that is taxable, of course. Even better is if you have a combination of taxable and tax deferred accounts, so you can shift your allocation to preferred stock potentially to your tax deferred accounts. And then finally, it would be someone who is willing to take more risk, interested in taking more risk, but perhaps not as much as going into stocks. Again, it's a hybrid asset class, so it's somewhere in between the two. So if you find yourself in any of these situations, you may want to look into it.
Yeah, and Alex, do you want to comment just quickly why companies are issuing preferred stock versus debt?
Well, there's a variety of reasons. That's right. So in terms of preferred stock, as I already mentioned, it's non-voting. So that's huge. Many owners, they do not necessarily want to dilute their ownership. So that's important. Preferred stock pays dividends, so it's reported differently, and it can actually be discontinued. That's an important fact, by the way. I should have mentioned this earlier. One advantage of preferred stock though, compared to common, is if they stop making payments. In many cases, if they want to resume, they have to pay their preferred stockholders first before they resume paying dividends on common stock. That applies, by the way, to financial companies. Without necessarily going, this is probably outside of the scope of this presentation, but financial companies such as banks tend to issue preferred stock. And one of the reasons perhaps you would buy into financial companies is because they pay well. So.
Okay. All right, so we're, in terms of some ideas, and we've mentioned this before, right now interest rates on mortgages are at an all-time low, we're going to say again. And you really do want to make sure that you are looking at refinancing if it makes sense for you. The 30-year fixed are at 2.75, 15-year fixed 2.375, and I believe those quotes are about a week to 2 weeks old.
That's right.
You can always see new quotes on bankrate.com if you want to look. And it's interesting because I'm going to say the old days, we always said, there should be about a 1% spread before you look at refinancing. Well, if you're looking at this rates, that's sort of out the window. I mean, it could be 0.25 or 0.50%, and you really should be looking at it. It's very competitive right now, I would tell you that. And what I mean by competitive is that the costs are pretty low because they've got such a big volume of refinancing that's going on. So, definitely pay attention to that. We're not expecting rates to be jumping around this year, but how much lower can they possibly go? So a good time to really be looking at that. Or if you have, a situation where just to look at kind of the reverse, is we have some conservative investors that really want to hold a pretty large percentage of their portfolio in fixed income. And of course, as Alex was saying, it's very difficult to get income from a fixed income portfolio right now. It's very low. So kind of the reverse of, not having much on the debt side. We don't have much on the income side either when it comes to interest rates, which is what can make it be really attractive to say, why don't you just pay down your own debt? So if you're even paying 2.75 or 3%, and we can't get that in a fixed income portfolio, and you're feeling, very conservative, then it probably could make sense to pay down your own mortgage. We're just doing that with a client right now that we just set up for paying off their mortgage over the next year. So we're paying more, taking more out of the portfolio each and every month, again, not all at once, and paying down that mortgage so it'll be paid off. And that'll also improve their cash flow, right? So they'll need less money coming out of their portfolio since they won't have a mortgage to pay. So that's a possibility. So we're really trying to pay attention to people's mortgages, and I would say debt in general, but where it could make sense to be doing that. The other thing I'm going to throw in here that's not on the slide is really looking at the family as a whole. When we're doing financial planning for clients where we have the possibility, we're trying to look back a generation and find out what's going on with parents' portfolios or what their financial situation is, as well as children and adult children, so that we can be holistic in our advice. So for example, you could have a situation where your adult kids are carrying a lot of debt, maybe expensive debt, and you're not able to get any real interest on your fixed income portfolio. So why not consider being their lender and have them pay you interest? Maybe they're saving some money and you're gaining some money. Of course, I'm going to say that's a family situation. We've done a lot of these family loans that are very business-like, but simple. But the dynamics have to be right. You have to feel comfortable. Kids have to feel comfortable. Money can be a whole lot of things besides just earning more interest. But just to keep in mind that it is helpful to look, I'm going to say especially down a generation, to see how you can make the whole family situation be better. Of course, you also want to make sure you've got enough liquidity. I'm going to say that goes without saying. We're not going to have a client pay off debt and then not have any cash in the bank, that they might need for contingencies.
That's right.
Okay. So next slide. So we have a top 5, don't forget, and I'll go through this pretty quickly. The first 2 really are just to remind you of things that came out of the CARES Act that are for this year. That is the RMD, that means the required minimum distribution from your retirement account for those that were already over 70 and a half as of the end of 2019 are no longer required to take that money out. If you're talking about an RMD that's coming up for next year that you would have been 70 and a half, that's been pushed back to 72. So you don't have to worry about that anytime soon. The thing I want to point out is that if you've had money that came out the first part of this year, before these acts were in place or before we even knew what all the rules were going to be, you can replace those funds and roll them back over by August 31st, 2020. They pushed the date back just last month so that you've got time to think about whether you want to put that money back. That can also be from an employer plan where you took money out, but just know that that's the case. And we're also reminding people that take their required minimum distributions towards the end of the year, because they're not necessarily needing that money month to month to live on, but they're just doing it because they have to do it. To really look at that and not just assume that you would take 0, because this is not something where, it's like not an all or nothing situation. You could take some portion of a minimum out if you wanted to. And why would you do that? Because maybe that's primarily your taxable income. Maybe there's not a lot of other investment income. There's not a lot of other work income. We don't have a lot of capital gains going on this year. So maybe you end up in an extremely low bracket, or even in a situation where there's no income tax bracket and you want to take a little bit out because it's basically a tax-free situation. This waiver, by the way, for 2020 is a forever waiver for 2020. It's like 2020 didn't happen. So you don't have to catch up next year or anything like that. So just remember that, and basically to take a look at it at the end of the year to make sure you don't want to take something out. The other thing I'll talk about quickly is this ability to take a distribution this year by December 31st, 2020, of up to $100,000 out of a retirement account, IRA. And that basically doesn't have to be, it could be repaid completely within 3 years by the end of 2022. And it could be just simply taxed without any penalties, but you're going to pay tax on it proratably over 3 years if you don't want to pay tax all in 1 year. So there could be some planning with that too for someone that needs some cash. Maybe, the situation is that they've got a lot of other higher debt. They've got some compelling bills that need to be paid. You do need to qualify under the COVID definition, which is, I want to say, pretty liberal now, where you've had, somebody had COVID in your household, but also where you've had a drop in your hours, a drop in your income, some financial strife going on by anybody in your household can qualify you to be able to do this. I feel like I'm talking in circles a little bit because it's a tad convoluted to explain. But if you feel like you could be in a situation for that, you need to make the decision by the end of 12/31. And again, it's not an all or nothing proposition. You can take some money out that maybe makes sense because it's coming out tax free, or you could go all the way up to the 100,000 rule. The one thing I forgot to mention on the requirement on distribution waiver is it's also effective for Roth IRA distribution requirements as well as inherited IRA distribution requirements. So just to keep that in mind. And then the third one is really your 2019 tax return. I assume a lot of people filed yesterday and maybe got hit with those 2 first quarter installments on top of it, or maybe you filed an extension. But remember, this year is a different kind of year than 2019. 2019 was a very high investment return year. A lot of income people had to report. This year, we don't necessarily anticipate that to be the case. And plus, you don't have to take, a minimum distribution out of your IRA if you decide not to. So if you're paying estimated taxes this year and it's based on 2019, odds are that you're overpaying. You could be overpaying a lot. And what we're really telling people to do is to take a look at this before the 3rd quarter, perhaps in, August, and make sure that you kind of know that you're not just putting too much cash on the table for 2020 based on the year that it is. That can also apply to your withholding at work if you're still working as well. Same concept. The next one, the Roth conversion, and we've talked about this a lot. Just want to make sure, at least by the end of the year, that you're taking a look at whether you should be converting some of your IRA to a Roth and making it be now growing in a tax-free environment. If you're still working, there are some ways, some interesting planning of where you can do some of this even tax-free. And it could just be one of those years where it makes sense to convert something because you're in a low income year. So you don't want to miss the boat on that. You have till 12/31. We'll be talking about that again. And that's the same thing with taking capital losses off the table. So when we're talking about taxable accounts, not your retirement accounts, and you have something that's gone down in value to where it is at a negative, we're watching that pretty closely for our clients all during this year so we can take care of it in real time. Sometimes you just get a dip for some reason. You can look and say, oh, we have a loss situation, let's take the loss, but we're immediately reinvesting it. So it's not the same thing as a financial loss that I was just describing. It's really to harvest some tax savings. So now you've got it in the bank, is the way I consider it, and the money's right back in the market anyway. You definitely need to do that before the end of the year, and I want to say we've been doing that forever, right? Before 12/31 is looking to see if there's any capital losses to take, and you don't want to miss that by the end of the year. So and we'll be doing market updates. We're thinking probably right after Labor Day, sometime in September, and probably after the election, which will also put us into talking about year end. So that's our thinking right now, unless there's anything, remarkable to talk
That's
about.
right.
Did you want to add anything, Alex? What is our?
Yeah, well, one thing I always mention actually on the tax loss harvesting, one way to describe it, well, it's 20 to 30 cents on the dollar in terms of tax savings. So for larger accounts, let's say we're able to harvest, $100,000 in losses. Well, they may not be used exactly the same year, and I'll tell you in 2020, it's not likely that you would be able to use those losses to offset your gains. But in the future, again, we're talking $20,000 to $30,000 in tax savings. I mean, that's quite significant. And we've been, Debbie, we've been involved in situations and it was significantly more than that, and essentially eliminated capital gain taxes for the next 4, 5, 6 years. So it's extremely powerful. So I absolutely wanted to add that. So at this point, we actually have three questions that came when people register for this event. I'm about to cover all three. But if any of you want to ask questions through the chat feature, please feel free to do so. Again, we will not mention your name because this webinar is being recorded, so feel free to ask any questions and we'll do our best to address. If you're listening on your phone, feel free to unmute yourself and ask your questions. So please, I will start with actually a couple of questions and I'll address them as one. So I'm just going to read it. If your goal is to protect capital in turbulent market, what is the recommended allocation? ? My presumption is that with multiple waves of the COVID before a vaccine, the markets will be surprised, again. And I would say that's a fair assumption. And the second question, it's a separate question, but I do want to address them at the same time. I'm a retired, risk-averse senior citizen with money to invest. What can you suggest in these times? So to answer these questions, I would actually go back to one of the slides that Debbie discussed. Our step one would always be to address and make sure we discuss and analyze your actual cash needs. So step one to address both of these questions would be to understand how much cash you would need from your portfolio over the next 7 years. So to make an example, let's say you have $500,000. The amount doesn't really matter, and let's say we determine that you need $200,000 for 7 years of your distributions. So the proposed asset allocation in this case would be 60% to stocks and 40% to bonds. We would propose it to you. We would then talk about your other sources of income. So for this person who's a retired senior citizen, perhaps you have a Social Security, perhaps there's a pension in place. So we would need to adjust for that. And again, we would make this essentially proposal to you. Based on what we're discussing today, perhaps you would not agree that 60-40 is the best allocation for you, but the very least will have the basis for any future adjustments. We can start with 50-50, maybe even 70-30, but that would be our starting point. And again, we are expecting more volatility this year, so we absolutely want to be fully prepared for that later this year. I don't know, Debbie, if you want to add anything to that.
No, I mean, and again, I think when we're talking about fixed income and it is a buffer, so we're also trying to be mindful of when that money's coming out, whether it needs to be really short-term minded or it can be a little bit longer-term minded in terms of what we're trying to do to get some interest. But that's basically what we're trying to do. Is nothing really fancy there, but trying to make sure it's very much a buffer.
Okay. So before we talk about the third question here, we have a question. And again, I'm not going to mention the name, but I will read it out loud. Is it a good idea to invest in real estate versus bonds? Are bonds a better investment for retirement accounts such as IRAs? I am in my early 50s. How much should I allocate to bonds? I don't have a lot of money in IRAs. So do you want to try to address this question, Debbie?
Well, it seemed like it was a couple different questions.
Right.
Well, again, we can't really get into specifics, but when you're talking about real estate is not a liquid asset. Okay, real estate has closing costs to get in, closing costs to get out, repairs, needs active management of sorts, and is a completely different asset class. It is not a buffer asset. Sometimes people are interested in real estate, and we go through an analysis to see what the pros and cons are. Always trying to compare it against something, right? Because if you didn't do the real estate, you might have done something over here. And it's all about trying to do some projections. Like what could you get in a passive environment that wouldn't require actively managing this asset? What could you get over here? Is this really going to produce a lot more? So you're making assumptions about how long you're going to hold it. You know, in my opinion, real estate is a long-term asset class, so you better be thinking you're holding it for at least 7 years. I'm not going to get into the why, but some longer-term period. You probably want to be in a situation where you understand it. It's location, location, location. It's got a strong rental situation, and you've got a lot of liquidity to support yourself, you know, because you need a way to be able to offset that illiquidity. And, you know, it's a completely different asset class. And usually the longer the holding period, especially if it's your own real estate that you're in, and that's an asset too of real estate, then that's even better. But seen a lot of war stories, and, you know, usually for people that are really much in the business and understand it, that do renovation, that are, you know, really real estate minded, you know, has a better opportunity there.
Right. I mean, my only comment, and I think you addressed it perfectly, Debbie. Every so often I get a question, not on real estate, not on physical real estate, but on so-called real estate investment trusts or REITs. So the answer is actually, I mean, of course, very different, you know, would be a very different question, but the answer is the same. They tend to generate much more income, which is, by the way, taxed differently than common dividends. But at the same time, they're much more stock-like. So they're certainly not appropriate for the, you know, bond ladder portion of your portfolio. But I think that was not necessarily the question. I just wanted to add that. So next one from, again, not going to mention the name. What do you think about oil-related stocks? So unfortunately, you're asking a very specific question. I have plenty of thoughts on oil stocks. We actually discuss them quite frequently with our clients. Please reach out to us separately, and we would be happy to discuss it with you. We just can't necessarily talk about it, you know, in this format. Of course, you know, oil stocks specifically, they're pretty much in the bottom at this point, so I can absolutely understand why you're looking into it. What are your thoughts on Moderna? I also have plenty of thoughts on Moderna and many other, I shouldn't say related, but many other biotech companies that are working on the vaccine. Unfortunately, the same answer. This is not the type of question that we can address as part of this presentation. But I hear where you're coming from. Moderna is, again, all over the news at this point. You know, it shows up on our screen on a daily basis. What are your thoughts on investing in socially responsible companies versus companies that might be blue chips, but not showing much environmental or socially responsible friendly postures? So do you want to try, Debbie, to address this one, or you want me to try?
Yeah, why don't you try? I mean, just general conceptually.
Absolutely. So conceptually, I'll tell you, it's been one of our focus areas. We started following the so-called ESG stocks. That's how the category is actually called.
Well, we were actually at a webinar planned on this right before. Not a webinar.
I was just about to say.
Right before COVID.
That's right. We had a webinar scheduled just on that, just on ESG. Actually, I want to say March 12th or something like that. It was right before we kind of moved to, you know, working from home. So short answer is positive. I mean, we're thinking of them positively, but we have to be very careful. One thing I'll mention, this is not a form of any kind of investment advice. It's just a fact. A lot of ESG stocks are technology stocks. So if you look at many of the indices or many of the funds that follow this criteria, you'll see that many of them performed quite nicely year to date, because again, as we talked, this is one of the best performing asset classes year to date. But for anyone who wants to invest in ESG, we would be looking at different protection mechanisms so that their portfolio is really fully diversified. But overall, I mean, we're quite positive on that, and we do expect, actually more and more clients getting interested in that.
Yeah.
Which companies are ahead of the development of the vaccine? Which companies would be on the distribution side of the vaccine? That's a tough question. I would rather not, unless you want to try, Debbie.
Yeah.
I would rather not, because again, I have a partial answer. I'm not a medical person. I'm a financial person. Of course, I read the news, and there's a lot of people who following them at this point. Again, one of the first questions would be, what country are you looking at? Of course, all of us, or many of us, are focused in the U.S. In some parts of the world, they're already testing it. Actually, you may believe it, you may not believe it, but they're actually already testing the vaccine. So I would rather not answer that question, if you don't mind. Is it true that companies who develop the vaccine would not necessarily distribute the vaccine, and therefore their profits would be limited, versus companies that would be selling the doses and make a higher profit? Unfortunately, you're correct. That is overall, that is one of the issues here in general. And if we just forget about coronavirus for a moment, developing vaccines is not a high margin activity. Unfortunately, it requires a lot of upfront resources. There are some companies that are very efficient. There are some of them who actually dominate the market at this point. Two of them, I cannot mention their names, but at the same time, again, it's not necessarily an instant money maker necessarily. Okay, next question here. Can you comment on the energy sector overall in context of global issues? Do you want to try, Debbie?
Yeah, go ahead.
So sure, I mean, I'm happy to do that. So one of the things, so oil is a commodity, and oil, just like many other natural resources, they tend to be cyclical. They tend to follow different cycles. There's no shortage of oil around the world. And for many companies, and again, maybe I'll be jumping around a little bit here, in order for them to remain in business, the price of oil needs to remain at $40 or hopefully above. Again, what's important, there's really no shortage. Plus, as you mentioned, was it you or someone else was talking about this whole ESG idea? Well, many pension funds, by the way, we're talking about stocks of companies that, oil companies, they're actually not allowed to invest in those. So in terms of the global issues, again, I would be very careful. I would just put it that way. Next question. What are your thoughts on investing in socially responsible companies versus companies that might be blue chips?
Oh, you already did one.
You already asked this question, yeah. So I thought I addressed it. Again, short answer is we like it, but we have to be careful because a lot of those companies are growth-oriented companies. That would be my short answer. Anything else? So while people are thinking, here's the one that came from people who registered, from one of the persons who registered. What changes should federal employees consider now to minimize the risk to their TSP holdings from upcoming market volatility? Are particular funds likely to be affected more than others? And, assuming you're listening, I'm not sure who actually asked this question, but assuming you're listening to what I mentioned earlier, we're not able to provide any specific advice as part of this webinar. With TSP, however, it's a relatively easy determination. You have a total of 5 funds. 3 of them are equity-based, the remaining 2 are fixed income funds. So you would basically make a selection between the 2 based on your actual risk tolerance, and again, exactly when you would expect to take the funds out of your TSP account. Feel free to give me a call. It would be relatively easy to, again, address your question specifically, because inside of TSP, again, you have 5 funds plus the L funds, which are basically a combination of the other 5.
Okay.
Any other questions? That's good. A lot of questions.
Okay, well, I think we're good. Thank you, everybody, for attending. And as I mentioned, we probably will be scheduling something in September and in November. And there's other presentations that CBM is doing that you can find out from the website that'll be coming up. And thank you very much. Everybody stay safe and enjoy the summer best you can.
All right.
Thank you.
Thank you, everyone.
Thank you.
Thank you,
Thank you.
Badria.